In this video, we're going to talk about cash budgeting itself, looking at how we plan for the need for cash. This is a critical task in a business, right? We need to make sure we have cash when we need it. For instance, probably one of the worst things that can happen to a small business. Friday, it's payday. You're writing checks. You have 3 more paychecks to write, and you look and you find out that you don't have any more money left in the checking account. It's too late to do anything, right? You can't write a bad check, so how do you deal with the problem? How you should have dealt with the problem is dealt with it before the problem occurred. So again, this is a plan for inflows and outflows of cash. So we need to predict sales. How can we do that? We can look at what we've sold in the past. We can look to predictions by other entities about where we think sales are going to go in the future. But we need to, again, make a prediction of what we think is going to happen from a sales perspective. Once we have this sales piece, we need to estimate the cash flows that come from sales. Now, here's what happens, excuse me, in a business. When we sell goods, some of those goods are sold for cash, and some of those goods are sold on an accounts receivable. Now, if you look at real companies today, right, the accounts receivable piece, the piece that is sold and isn't paid for, we have to understand who's getting that money, right? I mean, it's still money that hasn't come in, but we have to understand where it comes from. Think of it, if you go to the grocery store, can you buy groceries on credit? That is, can you buy it today and not pay for it till the end of the month? Now, you can use a credit card, but a credit card is the same thing as cash to the grocery store. They get that cash. They get it very quickly. You can use your debit card, but it comes directly out of your checking account right into the grocery store. So that's not accounts receivable. Accounts receivable is where you have a specific account. Now, the grocery store, when they get groceries from their supplier, that inventory was purchased with an accounts receivable. So they have an account at that supplier to pay their goods. So we have to understand when we say accounts receivable, who are we talking about, right? Who actually owes the company money? But we have to figure out, again, how is that money then received? So we need to understand how our customers pay. So this is going to require some analysis of our accounts receivable. It's going to require some analysis of our accounts payable and how we make payments. So many other pieces of the business are incorporated into these cash budgets. So again, we have to predict sales, right? Again, we use this forecast. I think I might have had I have the exact same slide in twice, my fault. So the next stage then is an example. So let's look at cash receipts, right? So we have this company, it's a defense contractor. They're developing a cash budget for 3 months, October, November, December, the last quarter of the year. They have already received sales, right? 100,000, 200,000 respectively. So they predict moving forward 400, 300, 200,000 is this forecast. Historically, 20% of the company's sales have been for cash. Half of the sales they get 1 month after, and then the remaining 30% are 2 months after. Now, we can also incorporate in here a line item for uncollectible accounts. right? So we could have, as you see here in this worksheet that I've created, here are the sales. And now we have here's our forecast and our ratios. We could have a line item here for uncollectible accounts. So maybe it turns out that 4% of our sales are uncollectible. That would just be another line item that would reduce the total cash receipts for the company. But as we see here, what? In year 3 here, month 3, excuse me, we received $400,000, 20% was cash. So $80,000 was cash. Now, the next month, we get half of that. Half of 400 is 200. The next month, we get 30% of 400. That's 120. So if you add up these three, this diagonal, it adds up to the $400 or the 400,000. But we're looking for cash receipts. So in the first month, which is October, we expect to receive $210,000. Then 320, then 340. So those are the cash receipts for the company. The next thing we have to do then is talk about the other expenses, the outflows. Purchases. Historically, 70% of our sales, as you see here, 70% of our sales is paid the month we receive them. 10% is the month after that, right? And then 20 month is paid 20% 2 months after that. So here's our purchases, cash purchases, lagging 1 month, lagging 2 months. We also then incorporate all the other expenses here that we expect. Every month, $5, again, these are in thousands, $5 is the rent expense. Wages, we're going to make wages payable these months, 48, 38, 28. We're going to buy some plant and equipment. We're going to have to pay taxes, right? We're going to pay dividends, right? All of these expenses we predict we're going to have to pay. And I would reckon that most of them, principal payments, dividends, interest, fixed assets, these are known. You know what these are going to be. You certainly know what rent is going to be. Wages look like they vary a little bit. Taxes, again, we can estimate what we think taxes are going to be. But again, the idea here in the end is now we know the total disbursements per month. 213, 418, 305 for the 3 months that we're talking about in this example. So in the end, we just need to have a picture of what we think the cash flow is going to be each month. So here we have the receipts, disbursements, here's the net cash flow. Now, one of the things we need to know, how much cash do we have? At the beginning of the period, we say, look, we know what the cash was in the beginning. We started or ended the last month with $50 in the bank. So this month we added $50, right? Oh, excuse me. So net cash flow was out -3. So we started with 50, -$3 came in the door. So that means ending cash is $47. We need to have some idea of the minimum cash that we want. This company says they need to have a minimum cash of $25. So once we figure out what our ending cash is, we then have to decide what to do. If we have more cash than we need, that's the minimum, then we need to put that aside. We need to maybe put that into a marketable security. If we don't have enough cash, we can draw that from any previous marketable securities, or we can go out and we may have to go out and borrow short term. So here we see that the cash flows change from time to time based on our need. We always have at least $25 in the account, but we're also going to have some notes payable. We're going to have to go out and get some money if we're going to make it through this month and have enough cash. So we're going to have to borrow some funds for November and December. So again, we've talked about how we do this. We've talked about the decision we have to make in the end with excess cash. And we've talked about cash surplus, cash deficits, right? So this is a critical planning tool. Again, I mentioned for a company, for anybody to do anything, you must have cash. So again, we'll later on in some videos talk about short-term financial management, which again is going to help us plan for the cash flows in and out of the company. We have to worry about scenarios, right? So we have to worry about what if we're wrong? What if our sales calculation is wrong? So we may prepare several cash budgets. Look at a best case, worst case scenario. So we'll have several estimates, if you will, of our cash flow needs. And of course, we would want to cover probably the worst case scenario to make sure that we're always going to have cash and we'll never run short. And again, typically this is done at least quarterly, but I would think that most companies, especially small companies, are going to do this on a monthly basis. I don't think in general that companies, even small companies, would do this weekly. It's far too tedious, takes up too much time. If you're planning a month or 2 or 3 ahead, you're probably going to have enough money in any one week to cover any of the challenges that you might have. So again, as far as cash planning, typically monthly is the time frame that most companies are going to follow. Again, thanks for watching the video. Look forward to seeing you soon. Bye-bye.